Welcome to the chapter on derivative instruments. Understanding these financial contracts is essential for anyone pursuing a career in finance. In this chapter, we will cover options, futures, and swaps. These are the primary types of derivative instruments used in finance. Derivative instruments are financial contracts whose value is derived from the value of an underlying asset, index, or rate. They are used for various purposes, including hedging risk, speculation, and arbitrage. An option is a financial contract that gives the holder the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, known as the strike price, within a specified period. There are two main types of options: call options and put options. A call option gives the holder the right to buy an underlying asset at the strike price. Investors purchase call options when they expect the price of the underlying asset to rise. For example, if you buy a call option on a stock with a strike price of $50, expiring in 1 month, and the stock price rises to $60, you can exercise the option to buy the stock at $50, making a profit of $10 per share, excluding the cost of the option. A put option gives the holder the right to sell an underlying asset at the strike price. Investors purchase put options when they expect the price of the underlying asset to fall. For example, if you buy a put option on a stock with a strike price of $50, expiring in 1 month, and the stock price falls to $40, you can exercise the option to sell the stock at $50, making a profit of $10 per share, excluding the cost of the option. The price of an option, also known as the premium, is influenced by several factors, including the underlying asset's price, the strike price, time to expiration, volatility, and interest rates. One of the most widely used models for option pricing is the Black-Scholes model, which calculates the theoretical price of European-style options. The Black-Scholes formula for a call option is given by C equals S sub 0 times n of d1 minus x times e to the power of negative RT times n of d2. Here, d1 is calculated as the natural logarithm of S sub 0 divided by x plus r plus sigma squared divided by 2, all multiplied by t, divided by sigma times the square root of t. And d2 is simply d1 minus sigma times the square root of t. In the Black-Scholes formula, C is the call option price, S sub 0 is the current price of the underlying asset, X is the strike price, R is the risk-free interest rate, T is the time to expiration, sigma is the volatility of the underlying asset, and N is the cumulative distribution function of the standard normal distribution. A futures contract is a standardized agreement to buy or sell an underlying asset at a predetermined price on a specified future date. Unlike options, futures contracts obligate both parties to fulfill the contract. Futures contracts are commonly used for commodities, currencies, and financial instruments. They are traded on organized exchanges, such as the Chicago Mercantile Exchange. For example, if you enter into a futures contract to buy 100 barrels of oil at $70 per barrel, with delivery in 3 months, and the price of oil rises to $80 per barrel, you can buy the oil at the agreed-upon price of $70, making a profit of $10 per barrel. Futures trading involves the use of margin, which is a deposit required to enter into a contract. The margin ensures that both parties can fulfill their obligations. Futures contracts are marked to market daily, meaning gains and losses are settled at the end of each trading day. A swap is a financial contract in which two parties agree to exchange cash flows or other financial instruments over a specified period. The most common types of swaps are interest rate swaps and currency swaps. An interest rate swap involves exchanging fixed interest rate payments for floating interest rate payments, or vice versa. This type of swap is often used to manage interest rate risk. For example, suppose Company A has a loan with a variable interest rate, and Company B has a loan with a fixed interest rate. They can enter into an interest rate swap agreement where Company A pays Company B a fixed rate and Company B pays Company A a variable rate. This allows both companies to achieve their desired interest rate exposure. A currency swap involves exchanging principal and interest payments in different currencies. This type of swap is used to manage currency risk. For example, suppose Company X, based in the USA, and Company Y, based in Europe, enter into a currency swap. Company X agrees to pay Company Y interest in euros, while Company Y agrees to pay Company X interest in dollars. This allows both companies to hedge against currency fluctuations. Derivative instruments, including options, futures, and swaps, play a crucial role in modern finance. They provide tools for managing risk, speculating on price movements, and achieving financial goals. Understanding these instruments is essential for anyone pursuing a career in finance. By mastering the concepts and applications of derivative instruments, first-year finance students can build a strong foundation for more advanced studies and professional success in the financial industry.